Back with Indian Open right here on Bloomberg Quinn. The markets are flattish in the session, so no big moves there. Some heavyweights might be just holding out, the likes of Reliance, etc. But otherwise, it's a very flat start to the trading day today. What about consumption and what is that doing? Well, a lot's been said about that already, the slowdown in consumption, that is. One argument is that it's not a lack of demand, but a lack of funds. NBFCs that account for a large share of consumer lending have turned cautious amongst the liquidity crisis, and that's impacting not just the high-value products, but the low-value products as well, because the supply chain has gotten disrupted. What is the consumer sentiment on the ground, however? Let's put that question across to Ankur Bisen of Technopak. He joins us right now on the show. Ankur, good having you. Thanks much for joining in. In your experience, having looked at trends in the past as well, how would you categorize this consumption slowdown, which has lasted a lot longer than the previous ones that we've seen?
It's a mixed bag of story when you say consumption slowed down, because what we have seen is there are very interesting sub-trends that play out in consumption. And it depends on who you pose this question to in the consumption theme, and you will get some very divergent or often contrary viewpoints. Yes, at a macro level, consumption has slowed down, and which is reflected in the automobile sales. It is reflected in some of the FMCG numbers that are reported. But then if you look at some of the value fashion retailers, if you look at some of these premium food companies and the way they are growing in India, it conveys a very different story. So my view, therefore, is that consumption, rather than to be looked at as one big theme, needs to be looked at from a category viewpoint, from a demographic viewpoint, and from a rural-urban split viewpoint, and then you will see some interesting plays emerging in consumption.
Are you? Are you saying, just before you come on to the next point, that continuation of the point, am I understanding you correctly? Are you saying that if we dissect or if we break down consumption into a lot of micro segments, etc., then the overall consumption slowdown, as we like to call it, is not necessarily very slow?
Yes.
Can you explain that? Yeah, you were just making that point.
Yeah. So, for example, let's look at value fashion retail, and value fashion retail signifies fast fashion that sells fusion, that sells Western, that sells ethnic, and you look at the growth of Trend, you look at the growth of ABRL, you look at the growth of V-Mart going into tier 2, tier 3 towns. It conveys a lot about consumer, which is that consumer is not as brand conscious as it was earlier, or as we make out to be, but it is style conscious. It is looking at good deals, it is looking at good value, and that is reflected in the growth of private label retailers all over. So their growth continues unhinged, that their same store growth, new stores, and the kind of funds that these companies are putting in new stores and just to sort of convey the value fashion story is very strong, and that's not going to change. And this entire value fashion retail play also reflects how the demand is moving slowly towards tier 2, tier 3 towns, and these are some latent demand pockets which were not addressed earlier, because obviously the entire consumption story looked at the obvious mega metro themes, but they're all saturated, they're highly competitive. Where do you get the next set of growth from? And that's where the value fashion and the tier 2, tier 3 city combination is playing out. So I don't see anything there as far as consumption is concerned which is wrong. Same is the case with jewelry retail. Now, jewelry retail, we have seen in the last while the last 1 year, it has faced challenges which are more supply side, which are more regulatory, which are GST driven. But in the last 5 years, today, for example, 35% of jewelry is sold through organized retail outlets. If I look at 15-year back story jewelry, everybody would talk about neighborhood jewelers and their entire value proposition, and it's very difficult to sort of overcome that. That is no more true.
Ankur, the point being, so I buy your argument, there are some sub-segments which are doing well. The counter to that, and please weigh in on that, is that some of these sub-segments don't necessarily have the kind of base that some of the benchmark headline-grabbing segments have. And if indeed the consumption uptick was as strong or not as weak as people make it out to be, it would reflect somewhere, right? In GDP, in GST collections, in other things, all those numbers have largely remained stagnant, even if they have not fallen as much. So yes, there could be sub-segments that could be emerging, which could become big, but the headline numbers also need to pick up a bit for us to be sanguine about consumption, right?
Yeah, I totally subscribe to that viewpoint, and the simple reason is that if you look at the consumption basket and view it as 100%, 67% of consumption is need-based consumption, is consumption that reflects food, that reflects FMCG, and that reflects need-based merchandise. And that's the reason why these sub-segments, if I talk about fashion, if I talk about jewelry, if I talk about all the categories, they are all bunched into that 32% split. 67% is food and essential commodities, and that's where you see a downturn, and that's why this does not get reflected in the overall macro theme of consumption. And that's why we talk about consumption slowly. But the limited point I was trying to make is that it's not entirely a demand side issue, which I was just listening to the previous comment, the previous guest was talking about it. There are supply side constraints which are sort of making consumers delay some of these purchases, which are largely driven to EMIs and loans. But then also, if you look at some of these consumption story themes on food and FMCG, which is related to rural, which is related to income pool available. It's not as if they've stopped the use of FMCG products. It's not as if their need has extinguished. It's just that they just don't have the right environment or the right sort of the income that is available to sort of do the purchase. So that's why you see these trends playing out at a macro level. If I would take a blended view, because of the disproportionate share of food and essential commodities in the overall consumption basket, we see a muted sort of picture.
Ankur, so let's probe that a bit. I think we've heard a number of people come in and speak about how, because of the liquidity crunch, even if consumers don't have the liquidity crunch because there is a Bajaj Finance, Capital First, HDB Financial financing their purchases, the supply chain has that liquidity crunch, as a result of which it is not able to churn up even the products that are in demand at the pace that would be. One, how relevant is that argument? And two, the slowdown in high frequency indicators like autos. Now, a lot of people making this argument about how the new cars that are coming in, Morris, for example, are seeing 5-6 months waiting. But hey, that's not India, right? That's a very niche segment. Marutis of the world are not seeing sales.
Yeah. So let me take the first point, which you talked about, supply side constraint and how it impacts demand for the essential commodities. See, if I look at, I talked about 67% of food and FMCG play. We are talking about almost 550 billion worth of goods that is sold in this 67% play. And only 5% of this is pushed through any form of organized retail. 95% goes through a layer of distribution, wholesale and retail, which is informal, and has high credit in the system. So a manufacturer will give it to the distributor, a distributor will give it to the retailer or a wholesaler if the wholesaler is involved, and they sort of work on the credit system. High credit means 60-75 days cycle. So you need working capital to finance this cycle to make the food and the essential commodities meet the retail. Now, because of this credit crunch in the cycle, the supply chain, what has happened is that wholesalers don't have money to finance larger inventory. So they have now sort of started to look at smaller inventory sizes, smaller pack sizes, and they are sort of looking, obviously they're doing hand-to-mouth sort of an existence so that the working capital stress doesn't come on the books. And therefore, this entire, we see the stress as far as the essential commodities is concerned, which gets injected in the chain. So it's not as if the consumers are buying on credit and therefore NBFC is not doing well and therefore I'm not buying FMCG, but it is the supply chain and the disproportionate share of informal retail in the supply chain of food and essential commodities that gets impacted because of the way we are seeing the credit, access to credit being paid. Patanjali has talked about its distributors not being paid money. We have seen Emami numbers being reported and they've seen sort of some slowdown in rural retail. And I see somewhere this common theme of supply chain and the role of credit in the distribution and wholesale playing a role. The second part that we talked about, auto, I fully subscribe to the view new cars, waiting time 5 years, 5 months, 6 months is not India. Is a niche that plays out in top 10 cities, and these are new models that are good for headline grabbing. But as far as volume is concerned, as far as sustainability of auto sector is concerned, we're talking about mass selling models on a repeatable basis, and that is not happening. And I think that's where the entire credit and where people are sort of delaying their purchases. And let's not forget there is a big segment within the automobile purchase, which is commercial vehicles, where taxis are getting churned, fleet sizes are getting refreshed, and that is not happening. So people are delaying that part also as far as the offtake of vehicles are concerned. So yeah, that's an issue.
What do you think bounces back the fastest, Ankur? Where do you think, from amongst the spaces that are lagging right now, will the bounce back be the fastest? It's an assumption, of course, or maybe it's an educated assumption, but an assumption nevertheless. So I won't hold you to it if you're wrong. But what's your best guess?
My biggest, I would put my money on how FMCG bounce backs, because some of the numbers that are reported, that would be the first sign of some sort of a demand hitting the supply, and then the right buttons being out in retail. So FMCG growth bouncing back, because that will be reflective of a good monsoon, that will be reflective of some disposable income reaching the semi-urban and rural pockets, translating into FMCG purchases and therefore uptake. So FMCG sale bounce back will be a good indicator.
Okay, Ankur, we'll wait and watch how that shapes up. It will be lovely talking to you 3-4 months down the line to take stock of the situation again. But thanks so much for taking the time out and speaking to us today.
Thank you so much. Good day.
Yep, thank you. Well, that's Technopak saying that maybe the consumption slowdown is not as stark as we would like to believe. The consumer is not as brand conscious as it was, which according to Technopak, and FMCG could bounce back smartly from the numbers that have come out thus far. So 2 or 3 very interesting thoughts from Technopak.
Well, from consumption then to the NBFC space, non-bank lenders have been securitizing loans to shore up cash amidst the liquidity crisis. CreditAccess Grameen recently sold loans worth about 139 crores, taking the total amount securitized in this financial year to about 250 crore rupees. Is the lender now comfortable with its liquidity position? Do they plan to sell more assets? Let's get in and ask Mr. Udaya Kumar Hebbar. He's the Managing Director and CEO at CreditAccess Grameen. Thanks very much for joining in, Mr. Hebbar. Just starting off first with your overall calendar or your plan that you've chalked out for FY20 in terms of securitization. You've already done about 250 crores. Is there more lined up?
Yes, almost 20% of our fundraising will be a short-term nature, which could be securitization or a direct assignment or a commercial paper. So that is what our plan. And overall, 80% will be non-short-term, will be either medium or long-term. As you see in the quarter one, we raised over 900 crores, of which about 250 is the securitization and DA. And these are the calendar what we have. Almost 20% of our requirement will come through this securitization and DA, and which is going to be the way for the entire financial year. And we have enough opportunities for that and enough demand for that.
Okay, so that's 20% of your funding requirement. What about the rest? I believe you also have a very diversified funding resource with 30 commercial banks. You've got deals with FIIs, you've got financial institutions, private sector banks. So you're pretty well diversified in terms of the kind of funding sources that you have.
Yes, we have been well diversified. The liabilities has been our strength all the time. We raised money from domestic banks, private, public, or foreign banks, and from abroad, like foreign portfolio investors and FIs like IFC, and also through ECB in the INR. And we have a very good, almost 30% of our funding is a long-term funding, which is from FIs, FPIs, as well as the domestic FIs like NABARD, CDB, Mudra, that type of institutes. And the balance, about 50%, is from the commercial banks within India. This has been our strong liability diversification all these last 4-5 years. And we continue to have such diversification. And this year, we are looking at enhancing the foreign money or foreign liabilities higher, because there is an opportunity to borrow from internationally through non-INR or Forex also permitted by RBI recently. So we are exploring those opportunities. Looking the year ahead, we think we should be able to increase this foreign liability in this year. We would reach about 40% of our year funding from that source.
Okay, so that's going to be a big jump, 40% from foreign investors, and then you've got 20% coming in, as you already mentioned, from securitization. So basically, you're saying that you're comfortable with regards to the overall funding. You're not interested in looking at either NCDs or CPs or mutual funds as such.
No domestic NCD at this point of time, nor we never availed this domestic NCD. The international NCD, of course, we avail, which is one of the resource, which is always 3 years plus. So that always we avail, but domestic we are not looking at this point of time.
Okay. Mr. Hebbar, let's get down to the business part of it. And, it had been a challenging second half of, 2019 for the NBFC sector, but you've sustained a decent enough AUM growth of 44%. Is that something that you expect to enhance come FY20?
Yes, it was a good year for us last financial year. We withered this liquidity issues. We never faced any challenges, and we grew 44%. We anticipate to repeat the same. That is what we look at for next 2-3 years. We still grow between 35 to 45%, which is possible, and there's enough potential outside, particularly in rural, for our kind of business. And liquidity-wise, we are very comfortable. So with these factors are positive for us, we don't see any challenge to grow.
Okay. Also, let's talk about the overall plans of diversification and having a more granular approach to growth and concentrating growth in specific regions itself. So, if we talk about your increasing share of districts with exposures of less than 0.5%, that is likely to go up versus a bigger concentration on individual areas like Maharashtra and Karnataka. So, is that the approach that you're taking, getting more granular in nature?
Yes, I think you have exactly told that. So our growth in Karnataka, Maharashtra is reducing, though it is growing, but our growth in other states like Tamil Nadu, Madhya Pradesh, Chhattisgarh, Orissa are actually increasing in a quite faster rate. And there, the districts where we entered, where most of them are less than 0.5 or 1%, where the opportunity is quite high. Our process is to enter into a district, deep dive in that district. In 2-3 years time, we will be number 1 or 2 in that district. There is a process. In this process, in the Karnataka and Maharashtra district, by and large, we are number 1 in every district where we operate in these 2 states. And other states is the next growth momentum is happening. We expect the other states, all districts, to grow this and next financial year.
Okay, got that. On the other part, which is the provisions, I mean, for Q4, because of the one-off provision due to change in the ECL methodology, you did see that spiking a bit. But are you looking to be more conservative with regards to provisions as well, come to FY20?
We have been conservative in provisioning, which the methodology adopted already last year. I think we'll continue with the same methodology. There won't be change. The methodology specifically did 2 important things. One is the defining the stage 2 and stage 3. So stage 2 is any delinquency more than 15 days we treat it as stage 2, and any delinquency more than 60 days as stage 3, which means the provisioning will increase because of that. So which creates a cushion in our balance sheet, so that it's nothing but a conservative approach. If you see our balance sheet, we had 1.17% of provision as against GNP of 0.61%. I think this approach will continue to have in our book, so that we would remain a bit conservative in this particular provisioning norms.
And cost of funds also should remain under control for you?
It is actually, if you look at the continuing on an average basis, our cost of fund actually come down. Despite Q3, there was slightly increase in cost of fund because of some liquidity crunch around the cost of fund impact was there. But overall, for the year, our average cost of fund actually come down. So we anticipate to continue this trend, but it may take little more time now. But our cost of fund is not increasing at this point of time. And we anticipate to maintain our cost to customer actually within 18-19%, or almost 80% of our lending is within 18 and 19% to our customers, which will remain same for at least for next 2-3 quarters.
Okay, got that. Mr. Hebbar, just one last question then. And RBI is looking to issue draft guidelines for on-tap licensing for small finance bank by the end of August 2019. How well suited do you think you are to apply for this SFB license?
See, this opportunity was there for us 4 years back, and we did evaluate it, and then we decided not to go for it. Our belief is to work in rural, to work in low-income strata of the population. Of the regulation under NBS MFI is quite good, and we would like to remain a focused MFI player, and we don't have any interest to get into SFBs. We would continue to work with our customer segment, continue to define and create products for them and process for them, and be with the customer's behavior. For that, this license, this regulation is quite enough. We would continue to remain as NBFC MFI for this business. So I think we are very clear in our mind.
Okay, got that, Mr. Hebbar. Thanks very much for joining us. Really appreciate you taking out the time, and all the best for the upcoming year.
Thank you. Pleasure to be here.
All right. That is the management at CreditAccess Grameen. Not interested in the small SFB license. They're happy being the microfinance institute that they are. Growth is looking strong. AUM's 44% plus, and they're likely to continue with that.
Yeah, that's interesting. By the way, the markets have come off a little bit, especially the banks. So while there were buy calls there and the Bank Nifty had started off well, as the course of the day, during the course of the morning, the Bank Nifty has come off. It's about 83 points lower for the Nifty Bank. Let's wait and watch what happens thereof. Just one quick mention of the top contributors today, or the Nifty 50 gainers and losers, either of the options, and just show you what's happening to the large caps, at least, in addition to, of course, what will happen to the mid caps and the FNO stocks. This is what's happening, and pretty similar to yesterday. The top two, at least, HDFC and Reliance, are doing well. Infosys has come back there, but look at the other side. Kotak Bank, HDFC Bank, Yes Bank, all of them under pressure. And Yes Bank being in the top contributors list means that it would be having some serious pricing pressure in the session today. Do watch out for that stock under a bit of stick the last couple of days. And Yes Bank would be taking a bit of a stick in today's session as well. 6% lower for that one on 40 million shares traded, down to 102 for Yes Bank. Let's wait and watch what happens there.
I don't know whether Ravneet Gill's comment about having the next quarter being the time where you'll see a re-rating in the bank may actually do something, because at least for now, sentiment is completely washed out for Yes Bank.
You
it's
said
at
it right.
102 now. So it's just a matter of time now. We'll see what happens at the bank.
Any kind of uptick is getting met with some resistance in Yes Bank.
Yeah, the stock's now down 6%. But with that, we conclude this broadcast of Indian Open. Thanks very much for watching. All the futures and options action continues on the other side with the FNO Show.